Are you looking to get ready, be prepared, and transform your financial future? Then you've come to the right place. This is the Get Ready Money podcast with Tony Stewart, where Tony has insightful conversations with financial experts who are changing the way we think about money. Catch up on the latest financial trends and hear practical advice from Tony and his expert guests so you can build healthy habits that work. Be empowered with tips for implementing small changes that can have a big impact on your financial future. So sit back and get ready to hear from today's guest.
Welcome to the Get Ready Money podcast, changing the way we think about money with Tony Stewart. I'm pleased to be joined today by Jeff Kamys. Jeff is the Principal and Chief Investment Strategist at Inherent Wealth Fund. In this episode, we'll be discussing Jeff's thoughts on how we change the way we think about investment opportunities. Jeff, welcome to the Get Ready Money podcast.
Hey, Tony, thanks for having me. I'm glad to be on, and hello to your audience as well.
Yeah, fantastic. Thanks again for being here. So let's jump in. Tell us a little bit about yourself. What is your origin story?
Oh, my origin story. Well, I'm from Chicago originally. I live on the West Coast now. I've been more of a West Coast person for a long time. When I was in my 20s, I was playing a lot of baseball still, and I hurt my shoulder, and I couldn't do it anymore. I started one of the very first fantasy sports companies called Dr. Stats Fantasy Sports, and this was in the early 90s when we were essentially programming like Informix databases. It was a paper newsletter business, so I kind of built that out and ran it for like 18 years, and I kind of accidentally became successful. I didn't really have expectations, but it was sort of like necessity is the mother of invention. I created a bunch of things that I wanted as a person who loved fantasy sports, and then other people wanted them too. So it was an online business. I ran it for 18 years, and then lived in Oregon for a while. I moved. I bought another business, which is an agency, essentially a marketing company that does a lot of branding for high-level law firms in California and all over the country. And then after that, I got into built some enterprise software for the Dodd-Frank Act. Started another business, which is an investment advisory, which is what gets us here in the investment side. And I just actually transitioned that to my partner. That was called Baseline Investments. And now with Inherent Wealth Fund, I'm essentially back to my roots, which is sports and sports betting and the fantasy sports players so involved with it. And Inherent Wealth Fund, about a year and a half back, launched the iBET Sports Betting and Gaming ETF. And it's really kind of in my sweet spot. I know the industry, a lot of the companies that are in the fund, like DraftKings and FanDuel, actually started as daily fantasy sports companies. And then when we had the Supreme Court allowed states to regulate gambling, then this industry started blowing up, which is about 3 or 4 years back.
That's fantastic. So I think I'm going to ask you probably the most important question of the day, hearing you're from Chicago. Cubs or White Sox?
Right. I'm a White Sox fan. And what happened was I actually grew up on the Northwest side, so I was punished a lot by my friends. So if you can imagine, I also did the double header of pain because I was also a Green Bay Packers fan living in Chicago. Though I did teach my son. I did teach my son well. I said, I always told him that the best player in the NFL ever was Walter Payton, who I watched play a lot when I was a kid. And that was before you got 8 million games on every weekend. So you kind of were stuck watching the Bears. But I'm a White Sox fan. That was my dad's team, and I follow him. And we got our World Series. I think if you're a fan of sports teams, your goal is just to have your team win one in your lifetime. And the baseball one was elusive, and we got it in 2005, and I'm happy with that. And whatever else happens is just gravy. So, and I had the great Bulls runs with Michael Jordan. So I'm good. I'm fulfilled as a sports fan because all my teams have won in my lifetime.
That's fantastic. Oh, yeah. Jordan and the Bulls, that was amazing. But I remember watching Walter Payton play, and he was something else, just amazing.
It was sad that we lost him so early because I think he was a great citizen of the planet too, and had a lot more in him. He probably would have been an NFL owner at some point, is my guess. I think he was aiming towards that. He had a lot of different businesses. He was, the boo-boo of all time will be that in that 1985-86 Super Bowl that Walter Payton never scored a TD, but his career is so resplendent. Besides that, it's hardly mattersome. But I guess Peyton was really, really bothered by it, and Ditka profusely apologizes for it at all costs because, Refrigerator Perry got a touchdown and they did score 46 points. So there should have been a touchdown for old Walter Payton in that Super Bowl.
Yeah, but he still has some memories. So as you talk about fantasy sports, I play fantasy sports myself, and I love them. But it makes me think also about investments, because to some degree, are investments almost like building a fantasy team?
Yeah, it's such a crossover. Yeah, it's such a crossover. I when I got into it, I realized it was doing the same thing. And one of the things that we did with a fantasy sports company is we were analyzing trends, and it's no different than stocks. Stocks and players in fantasy sports are really similar, because number one thing I would always write about is, it's about finding value, right? And so when we talk about, like, Buffett just had an investor week for Berkshire Hathaway, and Buffett talks about it. He goes, "It's really simple." Now, it's not really simple. He's had his share of some losers too. Let's be true and honest about it. But the reality is you're looking for value. That's it. And so in fantasy sports, we would figure out, part of what made my business really successful is we found ways to create a bunch of tools to find value. I mean, I know it sounds funny now because everybody has this, but I know we were the first ones to create the dashboard for fantasy players, where we had stats. And then what we did, which was better than anybody, is we actually had customized projections for each player every week. Now, everybody does that, but I did this in 1996. So it was really unique in 1996 to have a one-line spiel about your player and have a customized projection about him in football. And actually, it was the death of me. I was writing so much. I ended up having to write 500 for 17 years, no kidding. I was writing something like 500 player evaluations every week for, during the football season.
Wow.
I loved it, but it was like that day was putting me through the ringer, and that's kind of why I pulled back from it, because my kids now, who are adults, they love fantasy sports, and they're like, "Dad, you should have kept that." Or even worse, they tell me, I wrote, one of the cool parts of that industry, I was so nascent in the industry, is that I wrote with people like Paul DePodesta. We played in fantasy leagues, like the people who are Moneyball was based on.
Wow.
Or, there was a company called Baseball Prospectus, and they actually went and they were hired by the Blue Jays to be in-house. And so my kids are like, "Dad, you're such a loser. You should have been a GM of a baseball team." But that's what happened. That's what happened to a lot of people that were in our industry. They became experts in it, and and that's a lot of baseballs run based on the Moneyball concept. And I think that's really just a simple thing. It's same as stock picking. It's finding value. That's all it is.
Yeah, and I think that's a good lesson for people out there, as they're thinking about investing, is that it is about finding value. And, I agree with you about Buffett. One of the things I talk about with my son, and you can see this at the annual meeting, is See's Candy.
I love it. That's my favorite bridge mix. That's the only place you can get a good bridge mix. I still go. It's bad. That's one of my, I love that though. It's great company.
Yeah, my mother loves it as well. I have some on my desk for her for Mother's Day. And when you talk about companies that provide value, and understanding that is, there's a tangible value to something like See's Candy. Right. And, that's really, I think, what investing is about, and financial products in general is, you can have a financial service or product, but the value isn't always apparent, or it takes too many ifs, ands, or buts. And I would say it's like getting that guy on your fantasy team who, has an injury history, and if somebody else doesn't get enough playing time, he's going to break in, right? Isn't that pretty similar?
You're taking your flyers. Yeah, it's right. I think a lot of times it's stories, right? I think when people talk to me, one of the things that's unique about my fund is, and the reason that people would like my fund, is my story is real. It's what happened to me. I love this. The people who are investing now, or who use these apps to bet on games, are the same people that were the fantasy sports players that used my site for information and data and played in leagues that I ran. And so I know this consumer really well. It's my consumer, that I've kind of grown with on the internet. And it's I think, it's about the story, and I think seeing more value there in something like a story of a See's Candies, and then kind of like the aw shucks nature of like a Warren Buffett who delivered papers, and back to kind of like a home neighborhood area kind of thing. I think people like that, and I think it creates that there's a feeling of it, and it's more, it's tangible, but there's also that intrinsic feel of something nostalgic.
100%, 100%. So let's get into some of the get ready questions.
Sure.
Tell us about what basic money concept do you wish people knew?
Oh, basic money concept that I wish people knew. I guess look, it's the basic one. Start saving when you're younger. That's really the simple thing. Take advantage of things like Roth IRAs or Roth accounts when you're younger to take the tax advantages of that. I also think that one of the things that people should learn more about money is that, it's great to have a job, but if you can work for yourself, you have so many more advantages on in the tax forms that can help you grow that business. And so you can keep a lot more of your money, and you can have a lot more of your money work for you. And I think, you need to, but I think this is the new consumer, the newer, younger person. There's so much information. I think they're getting more wise to it. But I think really, really the compounding thing is, and compounding is huge, right? So you put it in there, you put your $1,000 in a year, and then maybe next year you can put in 5,000. The compounding factor is so real. But so I read something once which I thought was really interesting, and I think it's about life. And I thought, and it was described as compounding everything, not just compounding money. Compound your knowledge, compound your experiences, compound all the things in your life, and think of it that way. And so I would think that's probably a lesson that you could take and put in money, or put it in your family, put it in your friends, and put it in all your avenues, maybe your work and things that you're involved in.
Yeah, well, that's great advice. And compounding is a word I hear a lot from my guests. And I think it's important, is that simple principle is a winning principle. So what is one simple thing people can do each year to set themselves up for financial success?
Okay, I would think, I think it's having goals. I think it's setting. One thing is that I do is I make a new goal list, and I put it in my inbox in my email, because I'll look at that every day. And you should have different kind of goals. You might have business goals, you might have personal goals. Business goal could be you want to grow some kind of business, or you want to bring in some new clients for the business you're working for. Personal goal could be a weight loss thing, or it could be some other thing, or you want to learn something new or take a class on something. And then of course, then a financial goal would be, I want to start saving money. And you could do that by like maybe cutting out the Starbucks coffee once a week or twice a week, and just putting a little bit more money in the bank. So I think really simple is setting those goals up and looking at them and doing them yearly, and having those goals in a place where you see them. It's really important.
Yeah, I love that, in a place where you can see them, because I think oftentimes we set goals and then put them aside and forget about them after a week or two.
Right. And that's why I put it
back
in my inbox, and it sits literally in my inbox every year. And I do it right around the first week of the new year. And I want them to sit there, and you have to kind of drift that box up a little bit, because it'll fall down in your bottom emails, but put it in there somewhere where you can see it, and make sure you look at it at least on a weekly basis.
Yeah, that's great advice. So, next is habits. What's one habit that people can change when it comes to their money?
Well, the easiest habit is just to auto deposit money in a bank. I mean, that's the easiest one. It's so simple to do it, and you won't notice it. And a lot of times money just is vapor. If you have money, you'll spend it. It's the easiest way is to just deposit something on auto deposit. I try to get my kids to even do it, and they're giving me a pain in the rear about it. And I have to constantly be on them. But, you don't need a lot of things. You don't need as much as you think, actually. When I had sold a large house that I had in Marin County for 18 years, and I moved, now I'm living in Southern California, but there was so much stuff that I wish I could have given more away, but they don't take everything. But you have so much crap that you really don't need that you never use. So, save that money, because it'll keep you from having the stress over it. And you don't need everything. Your kids don't need it either.
So, mindful spending.
Yeah.
Think about what you purchase.
Mm-hmm.
So I love it. And the other part about automating your savings, and this principle behind, the automatic 401k enrollment, is that you're putting the money aside first instead of after you're done spending, which I think is how people oftentimes approach it. So
Right.
starting
And
goals
for
first.
young earners, right. And for young earners too, taking advantage of things like Roths where, you're getting the tax benefits and, maybe you'll be able to grow that into something more and not be taxed on it later. It's such a great benefit to younger investors. But, I know too, when I started having a family, I wish I would have saved more money, but it seems like every dollar is gone. And it's hard too.
Yeah,
So
it's hard with a young family.
Yep.
But you do what you can. And I think that's the thing is, it's incremental. And we'll go back to our word earlier, it compounds over time.
That's right.
Even if it's just a little.
Right. And you don't have to. One of the things that people do now is they have so many opportunities to invest in stocks. It is wiser for sometimes just to be in like something that you can forget, like an index fund like the S&P 500. That's really simple. Now with Robinhood and all these Bitcoin opportunities, people look at it like it's FOMO, like they're going to make so much money. But, I can tell you the stories on the downside of those things have been worse than the stories on the upside. You hear a lot more. So just something simple you can put in, they can be diversified and get the market gains over time and not have to worry about individual stocks it's probably better. And that's kind of why like a fund like mine, if you're interested in gaming, it's sports betting, it's diversified. It doesn't make massive upside and downside days. I mean, we do have some of those occasionally, depending on the market, because it can be volatile. But for the most part, being diversified in a fund like ours that has 30 plus stocks, gets you a chance to play in the CAGR or the cumulative annual growth rate of the industry without having exposure to maybe one stock like a DraftKings or a Penn National Gaming. So people who were invested in DraftKings when it came out, it ran to like $80. Now it's making a really nice run over the last like 6 to 9 months. But people, that stock reset about $12. So people who had made money in it, weren't too happy when it came down. But if you were in a fund, you would have had more diversification and other stocks would have pulled that up and you wouldn't have had so many losses. So that's one way to look at your investing too.
Yeah. Don't put all your eggs in one basket.
There you go. That's right.
Something,
especially as expensive as the eggs are these days.
Yeah, there you go. Don't buy the expensive eggs.
Right.
So, what money myth are you trying to break?
Money myth? Oh, I think there's a book called The Millionaire Next Door, and it's about teachers. I have a lot of teacher clients, and they're very frugal. And it's because they work hard. They don't necessarily get the greatest benefits. They are very wise about their money. My mom, having been raised by my mom, who was a teacher, she worked 2 jobs a lot of times. When she was younger and our family was probably more expensive for her, she was working as a waitress too in the early stages of her career. I think that, anybody can save $1 million. And I have some teacher clients that have saved $1 million and people are surprised. And that's what that book is, Millionaire Next Door. So you can get there. And I know $1 million isn't what it was 30 years ago, but it's still a nice savings. Because if you get $1 million saved, and maybe not in a year that we've had the last couple of years where we have outsized inflation, but if you can live off 5% of what you save, you'll never eat into your principal, and that's kind of the concept you want to live by. So I think you can be a millionaire, you can save $1 million, and it's doable.
Just need to have a goal and a plan.
That's right. Put it in your inbox. Keep it in there.
No, but I agree with you, and I think that's good advice for people is to realize that you can do these things. It just takes a little bit of strategy and it takes a little bit of, I don't know if discipline is the word we want to use, but it's setting your priorities. Like you mentioned, is maybe not getting coffee 5 days a week. Maybe it's only getting coffee out 2 days a week and finding a balance.
Sure. So. It's really simple. People don't realize that the pennies do add up. I mean, it's a simple concept, but it's real.
Definitely. So, let's break out our time travel machine for a second. What advice would you give your younger self if you could go back in time knowing what you know now?
Oh, gosh. That's a good question. That's going to be, let me think about that. Advice to the younger. This isn't going to be necessarily about money. It's going to be more about personality. It's probably that I should have bit my tongue a little more. I can tell you, you lose this vigor as you get older. And it's not just that you're older, you're just wiser to not say the things you should not say. And I'm sort of a little bit of a lone wolf in my personality, so that I've had some opportunities where I've maybe wished that I had pulled back on the throttle, if you would, on things that I said about different things that happen to me in business. And sometimes that forces out things too, and it's like a flush. But I would probably think a little bit more than react, and I think we get there over time as we get less aggressive as we get older.
Yeah, I love that. Think before you react, and I think that's good with when it comes to money. I think it's very fitting for money, is because people oftentimes buy things and then it's like, oh, maybe that wasn't the best investment
Yeah.
to do that, or wasn't the right contract, or I come from the insurance business. That wasn't the right insurance policy to buy, but it sure sounded good when the guy was selling it to me.
Well, when I feel bad for like individual investors and they'll tell me what they invest in, when I talk, maybe I'm just out having a drink somewhere and they'll say, "Oh, I bought like Dogecoin." And I was like, "You bought it after they had talked about it so much?" And usually that's going to be the time when they're selling. So you have to be really careful about, if you hear some information is at the end of the run. And I always check things like RSI anyway. That might be too technical for your audience, but if you're buying something that's really popular, that's gotten really hot, you really need to check RSI, which is relative strength, to see if it's hit like an overbought condition. Because inadvertently, what usually happens with something like that is you've bought when it's over 70 or 80, and all of a sudden that thing's gonna just correct natural on market kind of corrections, just what it does. The market generally resets, right? We don't go to the moon, despite what people want to think about Bitcoin or these other things. It doesn't go to the moon. What it does is it usually riles up to a certain level. It hits kind of an objection point, or if you will, resistance, and then it kind of bounces back down because it's been overbought. And the market really does run pretty much on overbought and oversold concepts. And so I'd be very careful if you're going to get into something that's on a whim like that. And I would definitely check RSI to see if it's overbought. And maybe you wait a few days or 4 or 5 days to take a position, or a dollar cost average, and don't buy the whole thing at the top.
Yeah, well, and I think that even gets back to eggs. Is right now, well, eggs aren't as expensive as they were 2 months ago. The
Right.
price of eggs has come back down, and
Right.
I think that's that is an oversimplification of investments, but I think it's a good lesson. Is 2 years ago, eggs weren't that expensive. Eggs are not worth more than they were 2 years ago. Maybe they're a little bit harder to get, which is driving the price up, but eggs inherently are the same thing.
Yeah, I think
So,
one of the things that, well, we're not gonna, you're gonna ask me your questions, but I was gonna say about the Fed is that there's a lot of different things. There's a lot of lagging in a lot of the prices of things, because we had energy prices were so high that there's still a lot of lag of energy in a lot of these consumer goods that are commodities, whether it's eggs or grains and things like that. They've come down. And I think that's where the Fed's doing a really poor job. But I'm not going to, we get into some other questions later, but they also really don't understand they also don't understand the natural rate of unemployment that's gone down. And they also don't understand the gig economy, which is impacting jobs. So whenever they bring up jobs, it's really infuriating to me, because they don't understand that the numbers they're looking for are based on data from like 25 and 30 years ago. And it's Phillips curve this and Phillips curve that, but they need to really operate in a much more of a less back numbers and more current numbers. And it seems like, anyway, that's a frustrating topic for me. Sorry if I got on that. You don't want to go there, but I feel like
that's okay.
They've inherently missed a lot of things with what they've done, besides being a year and a half late.
Well, I think the takeaway here, though, is to update your game as things change.
Well, let me just give you one on that, updating your game. Why is everyone so old that's on the Fed? Why don't they have anybody in their 50s on the Fed? I mean, it's not a high paying job. And I know why those people probably, at the end, it's more of a lot of scholastics and academics. I think a Fed chair only makes, I'm not saying for the general public, I'm thinking for a job that holds the weight that it does and what it impacts. The Fed chairs only make about 200 grand. less actually. And I'm not saying that's not a lot of money for the world. I'm just saying that's not a lot of money for someone for the impact they have.
Yeah, one of the most powerful positions in the world.
Right. And why isn't anyone on the Fed on the chair that's like 50? You're all like 80 and 75. I mean, and so they have an inability to really grasp what's actually happening. I'm sure they know what the gig economy is, but I don't think that they really understand the impact of it. I mean, they probably don't understand how many people are trying to make money drop shipping or running their own little businesses or running classes and doing their own. They're actually, that's a big part of the push of the government right now, is to figure out how to tax those people, but they're not showing up on the Fed's data. And so when they're looking for 4.5 and 5+ unemployment, they're missing it because they don't know how to calculate those people. It's a frustrating thing for me because if they had more information, they wouldn't keep pushing. And I don't know how many banks have to go out of business for the Fed to understand that this isn't being helpful, because what it is it's actually creating a recession, and it's a natural deflator, because these businesses, you can't go and borrow 100 grand or 150 grand and have a small business because you can't get the money anywhere. So it's naturally deflating the economy, which is really kind of terrible. I started another site called Dumber Money. I just started it. It isn't even live yet. But, we always talk about dumb money and smart money. Now, dumb money is, of course, what they call the retail investor. It's kind of a rude thing to put it on that. And smart money is supposed to be these institutions. But what dumber money is, which is my kind of term that I coined, dumber money is really these institutions and people like the Fed who actually are making even worse mistakes than people who are individual investors who might lose $10,000 on Bitcoin. The dumber money is like the guy at Archegos who was trying to run up and down a bunch of these media companies and then got blown up to the tune of a massive amount of money. And so that's the dumber money. And I do think the Fed, with what they're doing, is lighting banks on fire with their interest rate flamethrower, is the dumber money right now. Anyway, I took your show and I took it hostage for a second there, Tony, but I'll let you go back.
Well, that's okay. But I think, the bottom line is to get back to the theme is having the right information.
Yeah,
and
absolutely.
That's the takeaway there. Yeah. And there are a lot of good issues, which would make a whole other good show. So to wrap up our conversation, what is your number one tip on changing the way we think about money?
Yeah, this is almost like philosophy. Like, I think that we have these predetermined, like, we need paradigm shifts in the way that we actually look at things. And I think that may be reading. I think it's more about education. And I think generally people build up these preconceived notions about certain things in the world, and they're usually ignorant, not in a bad way ignorant, but meaning they really lack a general understanding of why those things are happening. So I would say now we live in the greatest time ever for information, whether it's researching on ChatGPT or just researching on your own. Find out the information and find why it's a fear for you, because a lot of times people have a fear that's unfounded because it's not researched enough. That's what I would say.
Yeah, no, that sounds great. That's great advice. And I would agree with you 100% on that. It's shifting the paradigm. It's going out and getting the information for yourself and seeing how it fits. That's wonderful advice. So, Jeff, where can people learn more about you? Where can they learn more about your funds?
Sure. Yeah, they can look me up as I'm out on several podcasts. You can check me out. Not only your great podcast, but you could just search my name, Jeffrey Kamys, or you can look up Inherent Wealth Fund or the iBET Sports Betting and Gaming ETF, which I operate. You can search any of those things, and I'm sure you'll find me.
Fantastic. And for everybody watching and listening, like always, I'll have links to Jeff's sites and social media channels in the show notes. Jeff, thanks for joining us today on the Get Ready Money podcast.
I had fun. It was great to be on, Tony, and I wish you and your audience the best.
Great. And everybody, thanks again for tuning in. Please remember to subscribe to the Get Ready Money podcast. Until next time.